In this video, we're going to be looking at taxation. So what is a tax? A tax, the definition of it, the simplest way to describe it, it's a payment made to the government. So we have two types of tax. We have direct tax, okay, and we have indirect tax. So direct tax is an example. An example would be pay as you earn. So in the UK, we have pay as you earn tax. It's basically income tax. So the definition of a direct tax is a tax on income, property, or wealth. So when the government taxes you via direct tax, it's taxing one entity. Okay, so for example, it could be you, or it could be a corporation, a business, or something like that. So the tax has somebody's name on it, basically. Okay. Whereas an indirect tax, so this would be like VAT, this is a tax on a good or service. Okay, so it's not a tax on income, property or wealth, it's tax on a good or service. So it's not necessarily paid for by one entity. Okay, it could be paid by many people. So for example, VAT has to be paid by the firm, and then when the firm sells it on to the consumer pays the VAT and the firm claims the VAT back. So that's an example of indirect tax. So direct taxes, back to direct taxes affect disposable income. Okay, so direct taxes therefore will affect the demand curve. Okay, so as that is actually one of the factors of demand, your level of disposable income. So if taxes were to increase, if direct taxes were to increase, let's say income tax went up, it would mean disposable income would go down and consumers would have less money to spend on goods. So that would mean demand would shift to the left, like in this diagram. So in this case, in the case of indirect taxes, it will affect the supply curve. Okay, so with the type of indirect taxes you have specific taxes and you have ad valorem taxes. And here's the difference. So specific tax, it will shift the supply curve to the left, okay? But a specific tax is a tax per unit of consumption. So you're not taxing based as a percentage of the price. You're taxing, for example, for every single unit, for example, per packet of cigarettes. If, let's say, every packet of cigarettes had £4 worth of tax on it, every single person who buys a pack of cigarettes would be paying £4 worth of tax. So the way it shifts the demand curve, in this case to the left, it's a parallel shift. So notice that on the diagram, it's a parallel shift. And at all units, okay, all quantities here, we have the same amount of tax. So here, right, we have £15 being where what the original price was on the supply curve, but in this case it's gone up to £25. The tax is £10. The distance between the two supply curves is £10, and the same distance is over here. Okay, so the tax is the same at all quantities sold. Okay, now that's a little bit different to an ad valorem tax. An ad valorem tax is a percentage-based tax. Okay, so in this case we have the supply curve shifting to the left, again, just like above. However, the gradient of the new supply curve is a lot steeper compared to the old supply curve. And that's because it's not a fixed amount of tax, e.g., let's say £3 per unit. It's actually a percentage-based tax on the price. So the more the price is, the more you'll pay. For example, 20% of £100 is £20. So you pay £20 tax on something that costs £100. But if you now want to buy something that's £200, 20% of 200 is £40. So you end up paying more tax on higher prices. And that's the reason why the gradient of the second supply curve here is a lot steeper. The higher the price, the higher the tax paid. But the percentage that you pay is still the same. Anyway, so I hope this makes sense. Any questions, please put them down below.